Good afternoon, ladies and gentlemen. Thank you for your patience and welcome to a very special T3 Live presentation featuring our very own Chief Strategic Officer, Scott Redler. First, just to get the legalese out of the way, I'd like for you folks to go ahead and read through the disclaimer, just to make sure we're covered by the lawyers here. All right, let's get started. So many of you may have seen Scott on Fox Business News every Monday at 3:50 recently, or you may follow him on Twitter at RedDogT3. Some of you may already subscribe to his note each morning, or some of you may just know him professionally. Some of you may not know him at all. So let me take the time to describe Scott to you if you didn't know anything about him. I've had the pleasure of working here for the last 5 years, and Scott Redler was the first person to stand out to me as someone who truly loves what he does. It's quite inspiring to see someone day in and day out go about their business with that kind of passion and love. I can tell you from a first-hand experience, being in the office with him every day for the last 5 years, that this man works hard, probably harder than anyone I've ever seen do it. It's easy to see why he is nicknamed the workhorse. In by 5:30 a.m., Scott basically turns the lights on in the office every morning. He beats every single other trader here by a few hours to get ready for the day and to identify opportunity or manage positions. His commitment never wavers, both to his craft and to those that look to him for market analysis, also known as you, our ever-expanding and loyal trading community. Through his time in the markets, Scott has helped countless people make money by simply giving you what he does on a daily basis. What he does, his research, his analysis, his execution, and explanation around specific pivot points for specific indices and stocks alike are displayed for all to view on a daily basis through his Redler All Access program we will discuss later on in the presentation. Right now, we would like to present to you one of Scott's uncanny abilities to identify opportunity within a longer-term time frame by displaying and explaining some of what he provides year in and year out in his market outlook. So folks, without further ado, here is Scott Redler.
All right, good afternoon, everyone. Hope everyone's feeling good. What's today? Today is Wednesday. It's December. It's been a long year with a lot going on, and a lot of people who have done, very well this year, and a lot of people that definitely are scratching their heads and saying, "Hey, why is the Dow almost at 20,000?" Just in case you haven't heard, and I'm not, at the highs of my year, or I'm not having my best year, or whatnot. It's very, very easy to get thrown off your game. It's very, very easy not to follow a set of rules and disciplines. So I don't have a lot of time here today, so I want to make sure I can go over as much with you so you could leave this webinar with some tools and tactics and just a better, more organized, positive trader, moving forward. Thank you, Sammy, for that great introduction. So I'm not going to talk about me anymore. Let's just talk about you. No, I'm kidding. Let's talk about the markets, and let's move on, because in today's event, we're going to go over the lessons from the Brexit and Donald Trump's victory. Why the upheaval could continue. We're going to talk about the 5 moving average rules that can keep you out of trouble and make you money. I'm going to give you a little peek at my #1 trading strategy, not that you've ever heard of it. Then I'll look into the future. And I probably could take about an hour and a half on every single one of these subjects, so I have to apologize that I'm going to have to zip right through it. So if you happen to not follow along or you need to review it, we will repost this for you moving forward. So first thing I want to do is I want to talk to you about the Brexit. I don't know if any of you guys heard, but there was a situation a couple months back where a certain country wanted to leave the EU. And everyone in the world thought that there's no way this could happen, and that if it did happen, Europe would fall apart, the moon would fall out of the sky, and the stock market would crash. So there were opinions everywhere. So pretty much, I don't know where you were that night, but I remember that night I was watching the futures after, if they voted to leave, and basically you had a big move lower. So I think if you look at the slide right here, the Brexit breakdown, we call it, you will see that the S&P cash basically went from about 21.15 the day of, broke below the 8-day, the 21-day, the 200-day went down huge. Not that you ever heard that term before, and hit a low of 1990. So I think that was what people were expecting. People were expecting what's going to happen next. Oh my goodness, this could mean the end of the markets, the end of the European Union, the end of the euro. And P.S. a few days later, this happened. Wow, how did that happen? A lot of people were scratching their heads, including me, because I remember the day of the first candlestick. If you look at it right here, this was definitely something that, yeah, okay, you get a little snapback, but then right here, I remember actually being a little bit short and covering and saying, you know what, I'm wrong. That if the bears had any control, probably shouldn't have taken back this 2050 area, let alone go up another day. So right away, everyone in the world could see the exact same chart that we were all looking at. But as technicians and technical analysts and technical traders, we have an edge because we don't use our opinions and we look at the facts. So really what was important in this situation was not the reflex rally up that you saw 3 sessions after the decline. It was right here. And I remember this like it was almost yesterday or maybe 3 days ago. Look at that digestion. Look right here, guys. Remember the move lower, the snapback right here for 4 sessions. 1, 2, 3, 4. The S&P cash hovered in the upper third end of this range. If you're skilled in technical analysis, we would call that commitment to a move. If you're also, what another term we would say, if you use retracement rules to measure how strong a move is, this held the top third. Top third of a Fibonacci retracement holding means there's commitment and power. So even if you missed the short, missed the long, or if you happen to have gotten short here and said, what do I do now? This was your evaluation stage that we would go over in the morning call and we would go over in the recap to get ready so we didn't miss the next move. Because look what you also have here. You have a descending trend line here. So anyone who is short versus descending trend line, you basically have to get ready to perhaps cover. And if you look at the next slide, look what transpired. All right, so if you look here, you see this descending trend line. First, you see the reaction that was expected, the counter reaction that wasn't. So right here is when, as a trader, as a market participant, you had to say, you know what? Let me look at what's going on here. And what was going on right here was commitment and digestion to the breaking of a descending trend line, and then you had another 80 handles. I know a lot of traders that missed this move and made their entire summer in this move. I know a lot of stubborn traders that might have gotten short here, that might have added to their short here, that might have said, I still think the European Union is going to break up, this can't rally, and there's no way everyone on TV is calling for the next crash, and probably lost their entire year into that move, which is what I don't want you to do. Plus, I'm going to talk about moving averages later. Look where this candlestick was, reclaiming the 8 and 21 day, which if you know my rules, which I'll get into, that's when you actually look to be long, not short. So, what you want to do now is let's talk a little Trump. I don't know if you guys know who President-elect Donald Trump is. It's hard not to, but he's an interesting fellow, and I won't get into politics. But the good thing about the election was you didn't have to know who was going to win. You didn't have to know basically who and how the market would respond after the win. You had to just look at the action. And what we had is we had the Brexit situation to use as an example. Because look at the opinions that were going nuts here. Remember these headlines? Okay, let's go through them. S&P and NASDAQ limit down erases 2016 gains. Why investors are terrified of a President Trump. Investors think President Trump would make them poorer. The economic consequences of Donald Trump. These are all headlines, and you could probably look up 100 others, how everyone said the world was going to end, just like they said it was going to end in Brexit. And so right here, if you look, basically the market was below the 8 and 21 day and trickling lower because at this point, people were actually thinking that Trump was going to win because you remember that FBI probe? So you had the FBI probe, so people were selling down the market ahead of the election. And then, you know what transpired next? Remember when basically I won't even can't get into that next candlestick for you, but basically right here, you had your snapback. I think this is when the FBI director came out and said they're stopping the investigation on her emails. So the market responded and took that back before breaking the descending trend line. But the night of, you guys remember that night, that Sunday night when Florida started to come in as a Trump state at 9 o'clock, 9:30? I remember it because right here, this was the futures. Remember the futures that night? Down 40 handles, down 50 handles, down 60 handles. Actually, if you guys, for those of you that follow me on Twitter, right around, let's see what time that was. Let's see what time it was. 9:45. If I traded S&P futures, which I don't because I'm up at 4:45 every morning, if I traded S&P futures, I would never sleep, and my wife would be upset with me, and I would never spend time with my son. So I don't trade S&P futures. But I wrote, if I traded S&P futures, I would start accumulating under 2,050. Just saying. So basically saying, hey guys, you trade S&P futures, this is a good spot. I also identified this spot because I was looking at the calls and the puts the day of to try and figure out how I could plan out to be involved in the binary event. I chose not to do anything. So anyway, this was that night. So right around here, you happen to trade futures, and I actually got a lot of high fives saying, thank you so much. You just made my year because I was buying below 2,050. And then when Trump made his acceptance speech and he was kind of in the middle, that's when the market rallied. But anyway, this actually was like a little red dog reversal, which I'll get into also that night. So anyway, here's a little tweet. If you follow me on Twitter, which I tweet all day long to try and keep everyone involved, that was some value added. So anyway, let's go back to here. So the day, if you guys remember, the day that Trump won, we were down about 30 handles after being down about 80 handles. So what was the significance of the day that the market was done trading? Here was the significance. You had your sell-off, this snapback, then we broke this descending trend line, kind of like the descending trend line that we saw at Brexit. So what does that mean when you break a descending trend line? It means you might start a new trend. And there were some people that got caught long in this and got stopped out, and there were some people who got caught short here. Same way with Brexit. So there's another time when you could actually evaluate what this means. And there, right again, what do you see right now? You see digestion, a little bit of a different digestion. In the post-Brexit, you saw it below the trend line. Here, it broke above the descending trend line. So that means there was commitment to this reflex move, that it wasn't just a short squeeze and it wasn't just emotional. It was showing that there was actually real buying within these 4 days. So if you missed this move, you could have then taken a step back and said, you know what, I'm going to say if we hold above all these moving averages, which we reclaimed, why wouldn't we go back to the highs of the year, which was like at 2193, when we're still here at 2146? So that's 50 handles. So maybe you missed this, you missed the perfect buy on the lows, you missed the breakout above the descending trend line, but now you said, hey, I'm not going to be upset about it. I don't want to miss the next trade, let alone fight the next trade. So right after that digestion process, boom, okay, that's when you could have made your next part of your year. You could have made your November, right? Here is a look back. You can take a step back where you have the descending trend line, broke above these 5 sessions, digested. So this was your accumulation phase. And this was your add right here. Remember that day on Regular All Access I talked about adding there because it broke above this mini flag. And then from here, pretty much went straight as high as 2212. Okay, so right there you had 50 handles of calculated money based on the evaluation process, the same way you had your evaluation process here on Brexit. I'm just going back to it real quick because it's so similar. Look at that. Boom. Look at that evaluation process right here. And that led to about an 80 handle move. So fast forward, this really was something that was very calculated with defined risk and could have made your month. Besides the little extra, push above 2214, which was another pivot point that wound up creating a tradable level, and that was last week. So you come back to the lessons, because there's always lessons. Lessons prior to or after big events is, be careful with what experts claim that they know about the future. don't assume that you know how the market will react. And most importantly, price action, technicals don't lie, and they trump all opinions. So look at that snapback. Everyone's always like, Red Dog, it's so easy to look at, after the fact. It's so easy, once the chart is already in place. But the way you make money is you watch it as it evolves. And if you look at the granular charts in the prior slides where you had the reactionary move that everyone thought was the right move for Brexit negated. And then you had your digestion below the trend line right here. This is when you switch gears and said, hey, I'm getting long. I'm not going to fight this thing. 80 handles. And then here, pre-sell-off into the election, okay, because people thought Trump was going to win. Then FBI says, hey, we're going to stop the emails. Oh, now we think Hillary's going to win. You had the snapback. And then you had the Trump win, which was, price winning above the descending trend line. You saw commitment right here the same way you saw commitment right there. And this move was a lot more calculated. 60 handles you could have made if you would have said, I'm not upset about missing this, but I don't want to miss the next one. And you have 2, 3, 4 moves like this all year where you can make your money as a trader, besides a little add-on trade that we saw last week above 22.14. And then, again, you're always going to have different types of world-ending type of phenomenons. We already, looked at what's next. Italy voted no against the constitutional referendum. Later in 2017, you have France and Germany with their pivotal elections. Then, this one China, the trade wars are a possibility. Don't forget about the alphabet soup of the Fed, the ECB, OPEC, etc. And then you're probably already starting to hear about the honeymoon phase that Trump is getting right now because none of his policies are being implemented and we're just going up on hopium. But okay, that could last a lot longer and that could last a lot further than you being solvent if you start shorting too early. So the question is, like Reagan, what's going to happen next year? When will we hit a top? When will we start a corrective phase? Which sectors are going to be the leaders? These are all question marks that the market is going to tell us how to deal with. So what I'm going to have you guys focus on, I'm going to teach you a small little lesson, is on moving averages. Okay, these are 5 simple rules that can keep you out of trouble. You've probably seen them on Twitter. You've probably seen me talk about them in the morning call or the recap. Okay, if you take a picture on your cell phone of this slide and you keep it in your back pocket or maybe post it up at your house, get your wife or husband very upset, post them everywhere with little stickies. Above the 8 and 21-day moving average, stay long with portfolio approach. I'll say it again. Above the 8 and 21-day moving average, stay long with portfolio approach. Below the 8 and 21-day, you know what? We lost a little momentum. That's a time to get tactical. That's a time to probably limit your positions because once you get below the 8 and 21-day, if we're going to correct and we're going to have a bigger correction, you have to get below this first. So as a momentum active trader, once you get below there, you know what? You get a little bit more tactical. Even if it goes below and comes back, you can always get back in. But the time when it gets below here and then starts to go to the 50-day, the 100-day, or the 150-day, you can test those levels, which are usually 30 to about 100 handles lower, versus sitting in it on the way down. And you could also make some money, being short, because we do short stocks as traders also. Stocks move in both directions sometimes, just not recently. And then the last rule is anything below the 200-day, it's just, it's a very, very active short-term trading vehicle, and it's not even an investment. If you remember oil went from like 100 down to 25, and I think it lost a 200-day at like $80. So anyone that said oil couldn't go lower below 80, they sucked wind all the way down to 25 bucks. So, and then if it stays below the 200-day, which you stay below for 5, 6, 7 sessions, that means there's weakness. That means you're probably in a bear market in that sector. So, these are my simple moving average rules. I'm not going to give you a whole book verse worth of vocabulary and different, just different things to use with them. Cocktail napkin technician. Use these moving averages, and they will at least keep you on the right side of the market and try and keep you out of trouble. And now, of course, this wouldn't be a Red Dog event without another tactic that, you've probably heard me say, and I get the question all the time on Twitter, what's an RDR? What's a Red Dog reversal? You know what? I'm going to give you the definition of a red dog reversal because it's very near and dear to me. It's something I use every day. It makes me cash flow. It catches me swing longs, and obviously I like to, it's got my name in it, so it's kind of fun, and I'm glad that it makes people a lot of money. So here's a simple strategy, and it's changed over the years because of the computers and the algos. What it really is it's just a strategy for catching a counter trend move in an oversold stock or sector. Again, a strategy for catching a counter trend move in an oversold stock or sector. Stock could be down for 1 day, 2 days, 3 days, 4 days. In order to go down 5, 6, 7, what does it have to do? It has to trade below a prior day's low, right? If it's down for 2 days to go down the third day, it's got to go below the second day low. If it's down for 3 days, it's got to go down the third day low, etc. So the way this works is it trades below that prior low where everyone's going to think it's going down for an additional day. Shorts get involved, people start getting stopped out, and then it reverses back up through the prior day's low, and that's when the trade triggers. So you're not just catching a falling knife. You're not buying it on day 2, buying it on day 3, wanting to jump out of a window on day 4, and then puking it out on day 5, and then having a red dog reversal on day 6. No, this is a way to catch it. Okay, sometimes you get some paper cuts because it might not be ready yet, but if you do it with the plan, you'll always have a way out, and that's the most important, the calculated way out. So back to the strategy, once it goes below a prior day's low, comes back above it, you buy it, and you put a stop at the day's low or the current day's low. So it might sound a little confusing, so let me quickly give you two examples that I went over in the Red All Access and actually went over on Fox Business in the media. Let me show you the red dog reversal in oil. A lot of you guys were trying to trade oil with me. It was a focus before OPEC, and if you remember, the USOs were at 11.79. From 11.79, broke the 50-day, broke the 8-day, came all the way down, and right here at 9.74, which is, I don't know, probably about 20 to 5% lower, if you weren't caught in it, because you got out when it broke the moving averages, you had a perfect red dog reversal setup, where traded below 9.74, hit a low of 9.56, so you could be like a computer. Comes back above 9.74, you buy it there, and then you put your stop in at 9.56. So your risk is 22 cents, and that's what's very important. From 11.79 to 9.74, you're risking 22 cents. You know what? That's a high percentage play, especially considering oil was down near 42, 43 a barrel, which was the lower end of the range, which is why I talked about it on Fox Business, which you could actually Google. It's pretty cool. So the way the strategy works is you buy it when it crosses above this, and you have a great day trade, right? I think it went as high as 10, if not more. And then what I usually do is I keep a third for follow-through, because usually when you get a reversal candle after a big move down, shorts get squeezed and dip buyers come in, and sometimes you get a day-and-a-half move. And if you held the third, this was a great day-and-a-half move. So you could have taken the day-and-a-half, you could have taken the day move, the day-and-a-half move, or said, hey, you know what, I have a great entry at 9.74. I'm keeping my stop at 11.56. I mean at 9.56. And look at the size of the move that you had, to almost, almost 12. So you just made 25% or more in something that you had 22-cent risk on and never got violated. So this is when a red dog reversal could be a day trade, a day-and-a-half trade, or a major, did I say major? Well, I'll say major one more time, a major inflection point. And if you use a tier system, it also helps. So let me give you one more red dog reversal that happened today, okay, in a name that I don't trade that often, but it was on my Red All Access info sheet, and my other notables, meaning stocks on the move, was with X. Before I put up the chart, I want you to think to yourself, did you trade X today, which is US Steel, and what happened the past few days? So the past few days, X went down for 3 days. Okay, so a lot of guys were looking for some type of way into the stock with a calculated plan. So look what happened with X today. Hit 39.14 after a massive move, came in 1 day, 2 day, 3 day. So this morning, if you're trading, we're at probably around 11:30. It was below 34.18. Hit 33.78. Came back above 34.18. Okay, so right there, you could be a buyer at 34.18, a stop at the low of the day. I don't maybe have enough brain power to figure out the risk, but I think it was close to 50 cents worth of risk. Something that just came in from 39 to 34, so down about $5 for 50-cent risk. Makes sense. Came through, came back above. Okay, you could have, it closed I think somewhere around 35, so you could have made about 80 cents on whatever the position you had there. If you bought here, put a stop there. Just say you bought 2,000 shares, held it for the day, and then you hold maybe 1,000 overnight for follow through, because you did have 1, 2, 3, 4 days down, reversed. You would think, some people say, hey, I'm going to buy the dip here. I'm not playing it for momentum. At some point, maybe it could take that out. So you're buying it, what they call in the hole, using a red dog reversal plan. Because if somebody said, hey, I'm going to buy it here, you know what? It went below the prior low. Did it come back above it? No. So that would have been a try and a stop. This time it did. So for me, I'm long a little bit overnight. I didn't catch it perfectly today, to say the least. But at this point, we'll see what happens tomorrow. And if it gapped up 40, 50 cents, I would sell a third or so. And then maybe you could trail it versus this, and then who knows? Maybe U.S. still makes a new high coming into the end of the month. Or if it happens to gap down tomorrow, I'm not going to lose my entire day in it because I only took home a third. So if you took home just 1,000 shares and you made $800, you take home 300-400 overnight, just in case there's a little bit of follow through. So this red dog reversal happened today, and this was actually listed exactly like in my note, which I put tactical actionable trades in about 25 different names. But that's granular. That's daily. The unfortunate thing is, when you come to just say the big picture, right? The big picture in the market. So many people are like, why aren't people celebrating the potential of Dow 20,000? Why does everyone hate the stock market in some kind of capacity? You know why? I actually blame a little bit on the media. I blame it on the fact that every pull-in that's been 2 to 3 to 4%, that's when everyone, they all talk about the next crash. And everyone talks about the risks of being in the stock market, but nobody talks about the risks of not being in the stock market, not having a 401k, not having a 529 for your kids, not having a 403b. Everyone's, so worried about whether we're going to correct, but if you have a long-term plan, it doesn't matter. And you know why everyone's so worried? Look at what's been said in the since like 2012. Every time the market's pulled back, it's crazy. I'm not pointing anyone out in particular, but if you read, right here, crash, dead ahead, sell, get liquid now. Robert Wiedemeyer predicts 50% unemployment, 90%, not a 10% stock market crash, but 90% stock market crash. Harry Dent, back in 2011, this market will be cut in half. These are people who are fear mongers. These are people who don't talk constructive. Okay, and then you could go. I remember I was on CNBC Asia when Bill Gross came out and said the equity market is dead. I was like, how could you responsibly come on TV as a major talking head and say the equity market is dead? Look where we were. We were at 1275, and I remember that because I was talking about the road to 1700. So anyway, you can go up the entire thing, and this is probably one of the reasons why people don't invest for the long term. People are scared to pick a top and not have a plan. They're scared because everyone just predicts a market crash. And even if we were to, correct at some point next year, it doesn't matter. Especially if you have a 10, 15, 20-year time horizon, you have to know your time frame. I talk about that all the time, knowing your time frame. Are you an active trader who trades every day professionally for a living? Are you more of a swing/active where you have a job? You could be a doctor, you could be a lawyer, you could be a policeman, a fireman, but you want to find 5, 6, 7 great stocks, are you just putting money long-term in a 401k or a 529? Because if people paid more attention to this chart, look at that. Look at the long-term chart. Look how the bull market wins over time. You could go all through history. The Great Depression, you had a correction, okay? Then you rallied a base, broke out, post-war boom. Then here, the Vietnam War, stagflation, 1973 to 1975, sideways for probably a decade. And then remember the roaring 80s and the go-go's 90s? Well, look how long that was. That was about 20 years. So this was the year that I think, unfortunately, Facebook, the information age, you can get news so quickly. So everyone was talking about how they said the equity market is dead, that long-term investing doesn't work, et cetera, because nobody was able to really talk about it during these time frames. They just did it. Now everyone likes to obsess over the craziest headline that sells page views because that's how they pay for advertising. But anyway, that's a whole other ball of wax. But anyway, if you look at this was basically a decade. Okay, here was the global financial crisis. I'll tell you right now, I have friends who have kids in college. The global financial crisis paid for their kids' college because you know why? They started a 401k in 2001, put in every single month, cost average down, and then we came like this. So anyway, over time and throughout history, this chart proves the bull market wins. And if you look at, well, the aberrations, you have a descending trend line here and ascending trend line there, different channels, different phases for different approaches, but overall, the bull market wins versus focusing on the negatives on how you might get caught in the next crash or get caught in the next pullback. That's fine. So the most important thing is knowing your time frame and having a nice balanced approach to multiple time frames if you have the capacity to learn them. And we have probably 20 different types of tactics and trades and chart patterns and things we use to help time the market, let alone getting involved in a more active/intermediate approach. At this point, I think my partner in crime, Sammy, would like to talk to you guys about a few things.
All right, Scott, we really do appreciate that. An amazing presentation. We do have several questions that we have here. We'll get to those in a few. But folks, you're probably wondering why we're having this particular special event this evening. And the answer there is very simple. Basically, what we're doing is we're presenting to you the 2017 market outlook. And in doing so, I wanted to explain to you exactly what it is that you did receive. First and foremost, it's a 40-page report. This 40-page report will give you a long-term outlook, not only into specific stocks, but it'll let you know what Scott's thinking about as far as the S&P 500, NASDAQ, precious metals, oil and gas, and biotechs, along with many other markets. We get 3 quarterly bonus reports included in this particular 2017 outlook. So we're not going to just leave you flailing in the wind. We're going to go ahead and update you every 3 months, letting you know exactly where we stand, especially for your long-term position traders, to make sure that you know we're helping you manage any positions that you may have taken based off of the report itself. Of course, throughout the year, you'll be receiving trading tips that you can keep safe and sound, and you get this all for free. Now, there's ways that you can go ahead and subscribe to this particular Outlook report. But first and foremost, I wanted to break it down in sections just to make you folks aware of exactly what it is we're providing for you. You know what you're buying. You know what you expect from Scott Redler. His work is second to none. So if you're new to trading, if you currently are trading and are not profitable, if you want to tweak your trading, be a bit more successful, the first part of our report will let you into the top 10 things Scott does day in and day out to be successful. Trading obviously is not easy. In fact, trading is more than a full-time job, but the results can be rewarding both in the self-fulfilling aspect and, of course, monetarily, which is the name of the game. So Scott presents 2 solutions to some problems, well, more than 2 solutions in my opinion, but Scott's outlook can help provide an opportunity for both longer-term position traders and day traders alike with tangible, high-probability setups from the start of the year. Furthermore, Scott's Redler All Access program can keep you abreast of shorter-term moves and opportunities to supplement cash flow throughout the year itself. And I'll let you folks know on how you can add both of those to your particular newsletter subscriptions. Section 2 will basically show you that we are completely accountable. Well, Scott is completely accountable as well as completely transparent in his approach. We want you to hold his feet to the fire. So his totally transparent approach will teach you how to fish as opposed to just throwing one fish in your boat every now and again. In his 2016 report, he did both. In fact, there were 3 huge fish that landed in your boat if you subscribed in 2016. Those fish were Amazon, Wynn, and FCX. If you continued to follow Scott throughout the year, you can agree that his morning note and morning call had kept you on track to continue finding quality setups with high probability for success. But that's not all Scott did for us in 2016. In this report and in reports in years past, Scott provides for us a year in review section that details all of the moves in our global economy that may have stood out as significant information to have for traders on any time frame. He explains volatility throughout the year, the S&P's year in review for overall performance, what may have affected the market's performance throughout the year with geopolitical events and or major news of any kind. He doesn't just talk stock market. He gets into the bond market as well using ETFs that track it to get a broader perspective of how the markets as a whole were affected by any event throughout the year, but more importantly to Scott, how price action dictates specific moves over time. In our third section, You'll get Scott's trading plan and forecasts. Anywhere from China to precious metals to oil and gas, Scott touches on all of these important factors that can affect how markets perform over time. And now that information will be at your fingertips, ready for 2017 year. But not only did Scott discuss the stock market and the bond market plus volatility, he also touched on currencies, discussing how the current geopolitical climate can change the way currencies are valued and traded around the world. With Brexit and the Trump election leading the forefront, having access to a plan of action for major geopolitical events like those is crucial to your success. Why do all the work when Scott does it for you with precision like no other trader on the street? And lastly, in the fourth section, what everybody is here for is Scott's major stock picks for the 2017 year. Last year, the average trade returned plus 17%, his biggest winner being Win at 70.1%. So on top of that, and we'll go ahead and show you some charts in regards to what we discussed and what Scott discussed in his 2016 Outlook report. Let's see here. First, let's go with Amazon. Amazon opened at $656.29 in 2016. Scott predicted a price target of $800 plus, and eventually over time, this year it hit a high of $847.21 in 2016. Now, that's a big gain if I've ever seen one. Win opened up at $67.43. Price target in Scott's 2016 Outlook report was $90. It hit $109.50 on highs for the year this year. And then finally, FCX, it opened at $6.60 and had a price target of $10. Scott also said he thought it would double. It hit a high of $16.35. So Scott's right there, right on the money. As you can take a look at these charts, this is a very good indication of how accurate Scott is. And this isn't because he has a crystal ball. This is because he does put in a lot of hard work and effort throughout the year. So just to recap what you'll be getting with this report, and again, I'll go over the ways. You do have 3 separate options and where and how you can buy it. You'll be getting Scott's 10 keys to trading success, a 100% transparent look at his track record, his incredibly accurate SPX and NASDAQ forecasts, stock picks with potential to crush the market in 2017, and of course bonus commentary on gold, oil, biotechs, and more. So as I mentioned, there are a few ways. Now, if you could take a look here, we do have a few people that did subscribe last year. Your market outlook was the best $99 I ever spent on financial education material. That was Jim from Maine. Can't wait to repurchase the Outlook report for 2017. Scott has made a lot of people a lot of money, and it's Will from New York.
Okay, well, let me see if I can get back. Give me a control of the presentation so I can get back to where I could show you a good example of digestion, which I also talk about commitment. So if you go back to well, I'll have my editor because I'm not good at this kind of stuff. Oh, here we go. So let me show you digestion. Okay, digestion to me is after a big move, you want to see, is there commitment to it? So if you look post-Brexit, you see the reflex move down, the reflex move up. It has to digest, right? From 1990 in the S&P cash up to about 2100 into resistance. It can't just go right through it. It needs to digest. It needs to let some people take profits who bought lower and some people get back involved, getting ready for another move and another powerful move. So within this digestion below a descending trend line, that was your clue to get long for another move, which wound up being about 80, I would say 80, 90 handles. And the same thing happened post our election where you had a move lower, a reflex up, and digestion above it. Sometimes like here, you had a move up and then it kind of rolled over. You didn't see digestion above the moving averages. Here, you broke through. Here's your 8 and 21 day, digested above, showing that there was demand for higher prices here, and then we had continuation up there. I can't get into my other chart, so I would be able to show you digestion other ways, but it's like a meal. Man's got to eat. So you eat a big steak, before you have dessert, you got to chill out, listen to some music, and wait for what's next. And once you digest your meal a little bit, then you can have some dessert, and then maybe you go for a jog once you digest it. But you can't move around too fast if you eat too fast too quickly.
All right. I have another question here. It says, what kind of moving averages do you use and how do you use them?
Okay, well, something we went over in the presentation too, where as a momentum trader, I like to use the 8 and 21-day moving average because, like, if you go to the slide here, you'll see post-election, we were below and playing with the 8 and 21 days. So this is when we were in a sideways to downtrend. Once we took these back, that told me, okay, the real money is not going to be made short. It's going to be trying to be in portfolio approach. And from 2140 even to where we are now at where are we now? 2260-ish. We haven't been below it, so that could have kept you on the right side of the market. If you look here, okay, back post-Brexit, if you would have got out of the market when we broke the 8 and 21-day moving average at 2090, you didn't maybe get capitulated out 100 handles lower when it broke the 200-day and got down to 1990. So I think as an active trader, I'm trying to stick with the trends for alpha and cash flow. I think you want to be in things that are above the 8 and 21-day moving average. And then if it gets below it, you know what? You look for an H cell setup, which is something we talk about, or you get tactical. So this way, if you move lower, you could retest, the 50-day and the 100-day, because sometimes it doesn't make it down to the 200-day. So you can get the opportunity of lower prices, and you're also out of the way if we don't get that kind of bounce, and we do get a correction or a corrective phase that turns into a deeper one where you don't sit in the pain of it. If you're active in short term, you get to be short, be out of the way, and wait for some kind of red dog reversal, and then see if there's commitment to that before you get a new uptrend, which usually gets reborn at another matter of time.
All right, thank you for that. Another question. What's the difference between a portfolio approach and tactical number of open positions?
Well, like just say here, here you're probably tactical, right? You're playing with the 8 and 21 day. Things are trending lower, so you want to sit in more cash in your trading account. You don't want to be sitting in too many things because when the market's going down, tide's running against you. You don't want to be long. You want to be short, and you want to just play little plays. Once you reclaim that and you get into above the 8 and 21 day, you take out the descending channel. You say, okay, you know what? Market's acting well, and I want to let the market make me money besides just trading it, and I want to sit because this is more conducive for an uptrend, so I want to let the market make me some money. So you do whatever you're comfortable with. Maybe it's sitting in 3 positions, maybe it's sitting in 6 positions, maybe it's sitting in 10 positions, depending on who you are. But a portfolio approach would be like, just say tonight, I'm long a little Amazon, which I bought options yesterday. I'm long a little X that did a red dog reversal today. I'm long a little Facebook, and I have some options on because we're acting healthy. I'm in 6, 7 things that if we trend higher, I'm gonna make money massaging those positions and also holding them. I know it takes a long time to feel comfortable holding positions. Some people like to be flat every day, which is also cool. But as you progress in your career and get a little bit more skilled, you want to be able to make money with the market versus just always, looking for those day trades. Maybe add tiers to your day trades. Like if you look right here, I remember this. This digestion to the post-election. I remember being long right here, the spiders, and then once this trade happened where it triggered above these three pivots that were probably within my note, I added to positions and I added my size because we just digested for 4 days. Now maybe we're getting in motion. So in portfolio approach, you want to massage positions, and then like tonight, we're a little overbought. So what did I do? I put a spider hedge on. So I'm in long 4 or 5 longs with the spider hedge because I feel like we're a little extended just in case tomorrow we open down 6, 7 handles. I cover some of my spiders short, and then if the stocks that I'm in are any good, maybe they go green, so I buy them in the hole, they go green, and you create cash flow that you would have done day trading around positions you're holding. So portfolio approach in a strong trending market above the 8 and 21 day moving average could make you a lot more money than just day trading. But when risk comes down and you start breaking them, instead of being in harm's way, you're tactical so you could take advantage of volatility.
Scott, we always hear you talk about your oscillator. Which oscillator is it that you use, and how do you use it?
Well, the oscillator is a combination of many oscillators, so it's not something that you could look up. You probably have to ask me about it. It's a way of figuring out how oversold the market is and how overbought the market is. So just say it used to be if you were plus 40, you were overbought. You had to be careful buying. The same way if you were minus 40, you have to be careful being short because you're that oversold. This year, we actually happened to get to minus 80 on the oscillator, in February, and plus 80 during the course of this rally. So it's not an exact science. It's like a complementary analytic. So if just say you're up 4 or 5 days in a row and the oscillator is screaming plus 70, meaning we just rallied 100 handles, you might want to be a little bit careful actively long, because we're prone for a pullback. It's kind of the same thing as RSI, which some people use. Same way if the market's down 4 or 5 days and we just got battered and bruised and you were short during the majority of it, you don't want to just all of a sudden be all in short when the oscillator's minus 40 or minus 50, because you're prone to some kind of snapback, and you're better off covering in the hole and then maybe shorting the snapback once the oscillator gets back to neutral. So it's just another tool to figure out your risk tolerance on either side of the trade.
Scott, can you explain what you mean by pivot points?
Yeah, let's look at this chart too. Okay, so from this move in the S&P cash, we went from 2160 all the way to as high as 2213 is this peak right here. This was 2214. So this is your pivot resistance. In order for, at this point, I was saying we should get to 2240 or 2260. In order to get to 2240 or 2260, what does it have to get to? This pivot resistance. It's got to get above 2214, 2213, and this was probably 2214 too. So once it cleared this spot, anybody who was thinking right here, we're going to get a double top and we're going to correct because we don't have the knowns of the Trump people giving the president-elect too much of a honeymoon here, whatever the opinion was that we weren't going higher, once we went through these pivot points, you had to adjust because the market was telling you, yes, we're going higher. So pivot points are usually actionable areas that tell you who's winning the fight. And right here on this candlestick, the bulls won the fight through these pivot points. Same way maybe right here, where the 8-day was, you had a small negative candle. So the next day when we opened up, I would have written down the low here and saying, hey, the low here is 2214. If we get below the 8-day, 2214 pivot, maybe we could see a retest of this 2193. So it's like basically it's a rubber match spot. I list it as a pivot saying, okay, this is your short-term action area where there's going to be a fight between the bulls and the bears for short-term direction. And when I do my charting, I look more at bigger, longer-term daily pivots to establish the direction. But you could use the micro pivots to help you with your share size. So when you see me in the morning, give you levels. Okay, I talk about upper support. This is micro support or a micro pivot, and this is your intermediate pivot. Usually, some pivots have bigger meanings over others depending on where they are. So right here, like this pivot area was much bigger than maybe this pivot, okay? And then same way, this pivot was not as important as this because this wasn't, there wasn't as much time spent here. So you might have short-term pivots to keep a direction moving, or bigger pivot areas for a chunkier move.
Thank you, Scott. Now another question. What is the best time frame to use your red dog reversal on?
It all depends on how you trade. I see people use it on a 3-minute, a 5-minute, a 15-minute chart intraday to control their sizing, and then I see people base their game plan around it on the daily. I like to use the daily because the daily could wind up giving you different types of trades. Because it's a bigger rubber match area. Like here, when you had oil come in from like 52 down to 43, this 974 was a pretty important inflection point because it was in the lower end of the range. So this 974 was, to me, very important. So it got below it, came back above it, gave you a good day trade, gave you the day and a third trade, and then also gave you a major inflection point all the way to where it is. But then you could also use a red dog reversal for a minor spot like here, okay? If you were looking for a spot to sell it, okay, or a rest, it traded through this, came back below it, that could have given you a sell signal red dog reversal that wound up giving you 3 days to the downside. So you could use it as a sell signal, or some people might have sold it here and said, hey, I'm looking for a short. So once it got below here, you could have shorted versus that and then made yourself some cash flow and said, hey, now the 8-day caught up, let me buy it back here. So you can combine the pivots, the red dog reversal, and the moving averages all in your decision-making process. And that's another one, you know. All right, so I'm taking you back. Some people are asking how, again, they could get involved for next year. So if you look at the bottom section, you see the buy now, t3live.com/Red Dog. That's where you go to the landing page to figure out how you want to get involved. And I told you guys before, depending on who you are, what I think is the best case for you and the best option for you. Again, if you're in the stock market and you like it, but you don't trade it every day and you have another job and you can't spend a lot of time with it and you just want to know what stocks I think could outperform the market, and you want to just say, hey, I got this amount of money to allocate, I'm going to put a little bit of money in all 10 plays, and they've worked out consistently in the past, so they might do that again. Option one, so cheap, $99. Are you kidding me? And then option two is if you want those stocks to maybe focus on for the first quarter or put some in your IRA, but then you also trade every week. Option two is the Outlook and 6 months of regular all access, which gets you the note every day, 8:30, that I start doing at 4:45 in the morning. The video, just in case you need some more reinforcement from reading it to watching it on the morning. And I apologize, sometimes, I don't have a makeup artist and, it's windy downtown. So when I walk from the ferry to my office, especially in the wintertime, I'm wearing this Nanook from the North jacket. So I got this big hood on and messes my hair up and my eyes are a little watery. So it's not like I'm in a major studio here where I have a staff making me look pretty for you guys. So it's more about the content so you could see it and take it in that way. And for option two, normally just during the course of the year, it's $500 for you. You're getting the Outlook, which one little play could pay for itself, and then the note every day that has 25 different plays that could create cash flow. Maybe you pick 3 a day or 2 a day. That's what most people do. And then option three, you get the Outlook report, you get regular all access, and then you get the VTF, which is the community of professional traders from around the world that talk all day long, post news. You see positions when they come on live. You see when they get taken off, and it's awesome. I took actually a trip in April to Central Asia, and I was training 100 traders on how to approach our markets, and I had to log into the VTF, otherwise I was lost. It becomes like a little buddy on your shoulder where you're like, hey, if there are people that if all of a sudden you can't get into the VTF at 7 o'clock in the morning, it's like they can't even trade. That's how awesome it is, and that's how reliable it's become for them to make them feel comfortable to see what everyone's doing so they could help their decision-making process. So you have option 1, 2, and 3, all depending on how much time you want to allocate. But today is probably one of the only days you're going to be getting this stuff for this type of discount. And I have people who say, are you kidding me charging me this little? You should be charging me, what is it, $2.99 a month for a regular all access in the note versus, for the year. But we want to try and get as many people in the community as possible.
Really, one good trade, one decent trade can pay for the entire year of regular all access, plus the Outlook, plus a free month in the VTF, and then one more good trade could pay for an entire year in the virtual trading floor. So it really is a very good deal. It's very, very valuable in my opinion. I wouldn't call it cheap because it certainly is not cheap. It's very. Remember
last year? Last year I got so much flack because the first month the market was down, and then literally when I had FCX in it as my speculative stock that could double, people were like giving me hate mail. They're like, didn't people on Fast Money say it's going to be bankrupt? Didn't people say it's $1? And I was like, listen, I'm just telling you that I think that this stock that's been battered and bruised got oversold because of tax loss selling, and I think it can get to 9, maybe even 13. It's at 6. And then technically it actually was a lot less risky because the charts wound up setting up for really nice plays, so I had it on regular all access besides just in the note, and guys made money trading it and holding it. And that's the beauty of doing option 2. You can get the hold, you allocate your money, and then when it turns into a trade with a great chart pattern, whether it's a wedge or a cup and handle or some type of compressed pivot that expands and resolves upward, you get the best bang for the buck. So again, this is me trying to put my best ideas for the year and for the day and for the minute all in 3 different options for you discounted today before I actually have to head out and meet my Ragnar team because we have a team dinner tonight.
As Scott mentioned, this is actually only for a limited time. This is the pre-sale to the actual release of the Outlook report. So it'll only be offered at $99 on its own for a very limited time. In fact, I believe it's going to end by the end of this week. So you have until Friday at midnight to either email in or call us. You can reserve your Outlook report for $99 on its own, or receive 6 months of Red All Access for $295, including the report. Or even better, receive a full year of Red All Access plus 1 month of the VTF, and of course the 2017 Market Outlook Report at $495. Now, Scott, just before you jet, I know you have to get to dinner. I have one or two more questions. Do you have a little bit of time?
All right, shoot them.
All right. So one question is, how do you determine when to sell if you're long a position? In other words, how do I ensure I don't leave money on the table?
Listen, everyone leaves money at the table. If you follow me on Twitter, last week around Wednesday, I posted a chart of XOM. Go to my Twitter feed, you'll see the chart. I did that in Disney as two different types of plays, and they're not in my usual wheelhouse. I'm usually in high beta tech stocks, and I was like, wow, XOM has a great setup. Gets above 88. I'm gonna buy more, and then I'll figure out when to sell it. So I thought yesterday was a great sell for XOM. I think I sold it around 91. And then today, I think it hit 92.50. But you know what? From 88 to 91, maybe I could have kept a little bit on to trail it. So that's why you see me say trim and trail. So this way, I don't believe in all or none. If you enter at a good price and add when it gets in motion, you could trim some, feel good as it moves into your target areas, and then stay with some and trail some as long as it acts well. So this way, you can get higher prices. But all or none is not in my vocabulary. I like to buy at good prices, add when it gets in motion, and then sell into strength. And usually I'm pretty much gone by day 3. And then if it goes up day 4, day 5, I'm usually a little upset, but I'll get over it because you don't go poor by booking some profits. But that's something I have to work on also.
All right. Well, folks, I just want to answer a few questions that I believe I can answer. The virtual trading floor after your first free month is $195 per month or $19.95 per year. You can contact info@t3live.com if you're interested at all in the virtual trading floor itself. Let's see.
Well, by the way, Sam, we came up with there's going to be 3 different webinars to go over where the picks from the Market Outlook are throughout the course of the year. We added that last year, right?
That is correct. So I apologize if I didn't mention this. We will do 3 updates throughout the year on a quarterly basis. So this won't be the only time you hear from Scott. It won't be the only time you hear from him when you receive the 2017 report. In fact, if you are a portfolio trader or position trader, you might appreciate the updates each quarter because this will let you know exactly where we stand and what Scott's particular opinion is going forward. Of course, it helps to navigate the markets with somebody who's been doing it on a daily basis and successfully at that. So I would encourage you, even just the $99 purchase is of great value because you don't receive just 1 report. You'll receive 3 more additional reports throughout the year, plus 3 more free presentations just like this. So yeah, Scott, you hit it right on the head there. You can email into info@t3live.com. Myself and Amber Capper will be available to answer any particular questions you might have regarding any of our products here. I mean,
You know what? Can I just interject because I do have to leave?
Please, go right ahead.
I just want to say thank you for everyone for coming on and attending. I tried to just give you a little bit of recap of stuff that if you follow us and you watch the morning call and the recap, you'll know that we did this day by day. Pre-Brexit, post-Brexit, in the moment. Pre-election, post-election, in the moment, every day on paper, in the report, in the note, and I try and give as much access as possible because I'm in there with you guys. I'm not just an educator. I'm not just a writer. Sometimes I get a little upset if I write better than I trade, just like everyone else. But the majority of my cash flow is made by being in the trenches with you, which is why I feel like I have such a great feel because I also know the emotional aspect of it where selling too early happens. Fighting a move happens. So I've tried to create all these rules from mistakes that I've made to help you make less of your mistakes and also at least give you a consistent approach to the market where you could develop your own process and not just listen to the quote-unquote experts out there because who knows what their real intentions are. And all I'm telling you is that our intentions is what you see is what you get. You can follow us so many different ways and connect the dots so many different ways, and it all depends on how you want to do it. And if you don't and you just tuned in, that's cool too. You bettered yourself, you educated yourself a little bit more, and then maybe next step along the process, you'll make the plunge, and we'll be here for you. Still tweet me on my Twitter, watch the Morning Call Express. But if you really want to have a better, just a better situation for yourself, as well as putting yourself in a better position to win, let us be the voice and friend on your shoulder to help, just create those right decisions for you, keep you safe, keep you profitable, and have some fun along the way, because life is definitely about having some fun, because sometimes it's just way too short. I have to turn in. I'll see you at the Morning Call Express or the long-form Morning Call, which I'd much rather see you all in there tomorrow.
Scott, thank you very much for the presentation. We surely appreciate all your hard work. Ladies and gentlemen, that will conclude our presentation this evening with Scott Redler. Thank you all for attending, and have a great evening.